Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
FedEx reported some numbers. Let's get back to the corporate earnings. Disappointing. They're saying tariffs are having an impact on their core shipping business. Let's get the latest on that. Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst, and host of Bloomberg Intelligence Taking Transport's podcast. If you like railroads, trains, trucks,
wait, he has a podcast?
Ships, he has a podcast.
He's joining the cool kids now.
He is. And if you're into all that logistics, transportation stuff, this Talking Transports podcast is the place for you. So go check it out. Lee, FedEx, what did they tell on the street today?
So their last quarter was a decent quarter, but the quarter looking forward, their first fiscal quarter, is not going to be a great quarter, and that's really just given the uncertainty that is being driven by the tariffs. So, they're seeing weakness in their B2B business, they're seeing weakness in their industrial kind of end markets, and they're obviously seeing some weakness for volumes that are coming out of China into the United States. So, these are kind of the headwinds that they're facing. FedEx is doing what it can. It has a couple of initiatives where it's trying to take permanent costs out of its network, because at the end of the day, the company is transitioning from one that used to be B2B, business to business, is mostly, the growth really is B2C, so that e-commerce business, which is more expensive to deliver. So what they're trying to do is create a more efficient network. And unfortunately for them, it doesn't happen overnight. It takes a long time. And this is a kind of a journey that they've been going through for the last couple of years.
Here's what was confusing to me is that UPS did the same thing, like in the last quarter. Like they were like, it's uncertain, we don't know what's going to happen. FedEx did the same thing, but the stock got really punished in after hours. And I appreciate it's just down 2% now, but why wasn't this already baked into the stock?
That's a good question. I was thinking about getting uncertain tattooed on my forehead because I say it so much. But
don't do that. That's going to hurt.
Or probably spell it wrong too. And what the reality is the stop and go and stop of the tariffs are making it very difficult for not only businesses to operate but consumers. You saw the other day consumer confidence came in below expectations. So the tariffs are really having an impact on volumes. Once we get more, I think really what businesses really need to know is kind of what are the rules of the road, and then they can operate within those rules. But the stop and go aspects of the tariffs can be really confusing and disruptive to supply chains, which is obviously, FedEx and UPS, their core to move that freight around the world.
When you look at FedEx businesses, what's their exposure to China? How are they exposed to China?
Well, they're exposed on their express businesses, so they fly things from all over around Asia, and obviously China is the largest aspect of that to the United States. It could be anything from commercial goods to consumer goods. So they do have a decent exposure. One of the other things that FedEx does is they're in the less than truckload business, which also came in a little below expectations, and that's been a tough business that's really kind of geared towards that industrial economy. So when you see the ISM being in contraction territory for 29 of the last 31 months, that's really weighing on that business. And FedEx does plan on spinning out that business sometime next year.
So what's the right question then to be asking for a FedEx and a UPS at this point? Because as you point out rightly, the uncertainty trade for transports is definitely front and center. Like no one's going to have a firm outlook. So what's the next question?
I guess the next question is, how are you restructuring your networks to be able to handle the more expensive home deliveries that we're all accustomed to? So, we're all accustomed to free shipping, when you order something online. How are they going to facilitate that at the lowest cost that they possibly can? Because they face competition, the FedEx and UPSs of the world. They face competition from local players, from gig economies, from the U.S. Postal Service, and so they really need to, bend that cost curve lower to be able to drive better margins. And, UPS and FedEx have been, again, trying to restructure their networks. And I guess the real question is, when is it going to end, and when can we see margins start improving? But I don't think that's going to be a 2025 calendar year story. I think that might be more of a 2026 story. And, as things normalize and volume begins to grow again, I think that should really generate pretty good margins in these types of businesses.
And Lee, let's pivot just here at the end here. You also cover the big ocean shipping companies. What are they seeing in terms of freight and cargo and all that kind of stuff? Again, in a world where we're operating with some uncertain tariff levels.
Yeah, well, they're enjoying the disruptions that are created, the geopolitical disruptions, because those are pushing rates higher than they probably need to be. So that's for them a net positive. The net negative, to your point, is on the volume side. We are seeing a surge of freight that's going to be heading to Southern California in the weeks to come, and so that is an incremental positive. But the problem is these surges in freight demand could create air pockets and much tougher to second half comparisons when it comes to volume. So you could have strong volumes near term, but kind of weaker volumes with the months months further out.
All right, Lee, always a pleasure. Thank you so much, Lee Klaskow. He joins us from Bloomberg Intelligence. He covers all the transports there. He's Senior Transport, Logistics, and Shipping Analyst. He's joining that podcast train. There's a Bloomberg Intelligence Talking Transports podcast. I thought we were the only BI podcast.
No, look at that. There's a lot of them out there, those analysts.
Branching
so check
out.
it out. Yeah.
All right.
They're the experts. So.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Alix Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. All right, up at the pantry on the 6th floor here, I start every morning around 6 a.m. with the bowl of Honey Nut Cheerios, and that is a General Mills product.
Can't go wrong with that.
They had some numbers that weren't very good. The company expects adjusted earnings per share to decline as much as 15% in constant currency basis this year. That's tough. Let's go to Rosero Pena. She's a consumer staples analyst at Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker Studio. So, Diana, General Mills, weak earnings outlook. Talk to us about what's going on in their business.
So it's pretty much what is happening across the packaged food industry. Volumes are not coming in, and they're going to have to invest more in pricing. So cutting prices as well as weak volume, it's basically flattish to negative organic growth. And that is obviously with a negative product mix is probably going to go down the P&L.
But why? Like, we still got to eat. So, and these are staples, right? So what's the problem?
Well, basically, there's a greater private label penetration. People are being more strategic with their spending, and they're not.
And so private label is like $3.65 from Whole Foods or something, right?
Yes, exactly. And in the past few years, retailers have invested a lot on private label brands, so the competition has become more fierce. And it seems that the brand equity that these companies used to have is not hidden anymore. Like, people are just not buying their products.
I'm one of them. I mean, before the pandemic and the inflation, I don't think I bought one private label thing ever. In fact, I felt strongly about brands, but now I'm like, screw it. And so we buy so many private label products now and I don't know.
And you're not the only one. We're seeing, like, across all age groups, particularly for Gen Zs, they're less dedicated to brands than the older generations.
What do you do about that?
Yeah, then you have to make your own private label?
Well, some of these companies do have some private label, but obviously they don't break it down, and they're trying to make it not as evident. And obviously they want to invest, they want to increase marketing. They're gonna probably cut prices, which is why you see adjusted operating income probably gonna decline 15% over the next fiscal year.
can they invest in their own private label brand, or is that market so saturated?
No, it's not necessarily like in the marketing side. That will fall on the retailer side to invest in their private label. But I'm meaning more on like this cereal, the branded cereal.
All right, I'm asking for a friend who may or may not be getting his first pet ever in his lifetime on July 16th, a dog, Australian Labradoodle. Talk to us about the pet food business. What's that like?
So they have been, it seems that part of their business stabilizing a little bit. They are now, and you probably will see fresh pet declining, I believe 4 to 5% today, because they're extending the Blue Buffalo brand into fresh pet.
So who's doing what?
General Mills is expanding Blue Buffalo into fresh food, fresh pet food. But fresh pet has like 90% of the market share. So obviously, that intrusion is probably hitting them. We're not necessarily that convinced. They weren't very forthcoming in terms of like the type of distribution. Obviously, this is more refrigerated food that needs a little bit different than like the boxes of cereal that they're used to. So we're still taking a look how they're going to distribute that and how they're going to kind of get share from fresh pet, which has like their own fridges and stuff.
What consumer staple brand is doing everything right?
I would say wow, that is, from what I'm seeing, probably, I mean, like yogurt, like you're thinking about Chobani, like those guys seem to be...
So like a specialty health sort of like, but staple-y place.
Exactly. Mm-hmm. You have, high protein, like all of the good attributes that people are looking for. I think those are like the ones that would probably benefit from this.
And I'll tell you what I still buy the brand, Campbell's soup. Maybe that's just a kid thing.
That's definitely a kid thing. But I feel that way about like generics. We talked about this at drugstores. Like you got to get the real Band-Aids. Like if you don't get the real Band-Aids, they just fall off. It's just terrific. It's very upsetting. All right, Diana, thanks very much. Diana Rosero Pena, Bloomberg Intelligence Consumer Staples Analyst, joining us there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Happy Wednesday, everybody. Alix Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We cover all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. We talked earlier about General Mills and sort of the issues there with the private label brands and store brands. So let's take another look at consumer products, but look at it at the lens of restaurants and restaurant valuations, kind of the haves and have-nots. Michael Halen, Bloomberg Intelligence Senior Restaurant and Foodservice Analyst, joins us now fresh out of a recent report. So I asked Diana this, like, who's the winner in the consumer staples? And she was like, ooh, and it like took her a while to get there because it's really rough. Same question to you. Who are the winners in the restaurant biz?
The two of the names that we really like this year are Cracker Barrel and Shake Shack.
Cracker Barrel, I still gotta go, man.
Yep.
It's the goals.
They hired new CEOs last year. They're really focusing on improving the operations first and then the marketing there. And so we're really excited about some of the changes and some of the early results. Both of them we expect to outperform pretty significantly on the top line this year.
Well, the Cracker Barrel, I mean, I know my way around a Cracker Barrel. I know where every little nudnik is in every store because every store is the same. And then, of course, the same order, the Country Boy breakfast. But
what's in that again? Is that like
the Country Boy breakfast with the country ham? Okay. And you get the biscuits and gravy. It's a whole thing.
It's a whole thing.
It's a whole thing. Unbutton yourself and sit right down.
Yeah, gotcha.
What are they changing here? What is it? Because that's kind of what they are. Seems like their DNA is kind of that type of stuff.
Yeah. So one of the first things they did was focus their menu. Right. There was a lot of items on there that were not selling very good and also bogging down the kitchen. That has made the experience better for the employees. Employee turnover has plummeted. It was down, high teens year over year in the last quarter. So that saves them a lot of money on training and things of that nature. As the longer your employees stay, obviously the better experience your customers get and then people come back. They're also touching up the stores. They're going to remodel the stores. Lighting and paint are some of the things that they're going to do across all the stores. Some of the stores need more work. They'll do the floors as well. That's something they're starting to do. And then they're ramping up the marketing. So now that the operations are running well, they're doing more social media marketing, TikTok. They just had their first NASCAR race, named the Cracker Barrel 400 down in Tennessee, right?
And Bristol.
And they're advertising on live sports as well as Bravo. There's a huge overlap between casual dining fans and Bravo watchers,
What?
and so
Did not see that coming.
Yeah.
So on the other hand, what are some of the companies that aren't doing so well?
Oh yeah, so some of the legacy casual dining brands. Casual dining in general is having somewhat of a renaissance this year.
What's examples of casual dining?
Chili's is the one. Chili's is rocking it.
Applebee's?
Absolutely, and Applebee's is not. So, so you got your preferences confused right now, backwards, I'd say. So yeah, Dine Brands, which owns Applebee's and IHOP, they're having a real hard time resonating with younger consumers and haven't been able to bring those consumers into the brand. They also have a large number of low-income consumers that visit those brands, and so that's really hurting their results. And then Bloomin' Brands, Outback Steakhouse is their biggest chain. They've same type of situation. They've struggled to bring in younger consumers into the brands, and their pricing got way ahead of itself. So if you compare them to Texas Roadhouse, it's a way more expensive experience, and yet maybe not a better product, not a better experience for the consumer, definitely not better service.
Your coverage is a great reflection of the consumer. What are your takeaways? How is the consumer out there? What are the restaurants telling you?
They're doing all right. They're doing all right. Last year was a restaurant recession. This year, results are better, and we expect them to get better in the second half. First quarter, there was some consternation, but it was a lot of bad weather. There was a bad flu season. There was some pullback by low and middle income consumers in March, but they seem to have rebound. Results have been pretty strong thus far, and the economic indicators that we watch are starting to get a little bit better. So,
are they valued appropriately for the conditions right now?
Well, me personally, I don't look at historical valuations because the market cycles change so much. I'm looking at it on a relative basis.
Okay.
Right.
Well,
and
relative to what?
Relative to the peer group.
Okay.
Yeah. And so
I see.
So it depends on the name, right? It definitely depends on the name, but I think restaurants are set up for a nice, strong second half. We also are going to have that tailwind of tax cuts, and so I think just having that be the narrative versus tariffs and war and whatever else, I think is going to help shift consumer sentiment and spending.
Just the quick service restaurants, which otherwise known as fast food, how are they doing?
Fast food is struggling. Number one, they're lapping harder comparisons from last year. Number two, they have more exposure to low-income consumers, which continue to be hurt by the inflation that we've seen, right? Okay. And number three, they've overbuilt. So since the pandemic, full-service chains, casual dining chains kind of pulled back on their development. They closed stores. Fast food has just been full steam ahead, opening stores. So supply and demand has gotten out of whack.
All right, Michael, thanks a lot. Really appreciate it. Really good stuff. I still got to make it to Cracker Barrel. Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst, joining us on the winners and losers of restaurant valuations.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.